main focus point today is about the 3 measures of risk that affect your portfolio and your need to take risk, okay? And how much risk you are taking. Now, risk and potential return are often tied, right? Higher risk, higher return is typically what is said. Now, that's not always the case, but they're generally correlated. But that doesn't mean that just because you take a lot of risk means you're taking smart risk. Or you can go to a casino and it's high risk, but your ultimate payout is not net positive over long lengths of time. So the idea of taking risk in the investment markets is taking calculated risk, taking risks that are worth the reward. And that's what we try to help you with on this show each and every day. And that should be your ultimate goal. It's not eliminating risk. It's good risk versus rewards. But you still need to manage those risks, whether they're good risk versus rewards or not. That's job number 1, is managing those risks. And you can do that through diversification as well as asset allocation. Now, the 3 types of risk. Number 1 is risk tolerance. This is your willingness to accept risk. Okay. So how much emotions do you feel when the market goes up and down and your portfolio moves a lot in both directions? Are you okay with that? Is that comfortable? Especially the downside? Is the pain causing emotions that could potentially cause you to sell at the wrong time, for example? So that's risk tolerance. Then there's risk exposure. So how much risk is your actual portfolio taking? And then there's risk capacity. This more has to do with your broad financial picture. And this is something we do for our clients. This is part of what a portfolio review is, right? We look at risk tolerance level. That's what, if you go on our website and take our risk questionnaire, powered by Nitrogen, that's the risk tolerance. Then there's the risk exposure, which is, okay, we put current portfolio into the system, and then that gives a risk score. And how close are they related? And then when a client becomes a client, we run financial plans and we figure out, okay, should the client be taking a lot of risk, maybe less risk, maybe not a lot of risk at all? I see this a lot where a client's risk tolerance is very high. You know, they were business owners, they were aggressive, they were winners throughout life because they were just sort of willing to take risk. But now they're later in life, they have a lot of money, they live fairly frugally, and it makes more sense to dial back the risk. There's no need for it. And then there's also people that are just hanging on, just have enough money. And, you know, those people, maybe if you take too much risk, you could be jeopardizing your entire financial picture, your entire retirement. So everyone's risk capacity is driven by their income, their expenses, and their life expectancy, right? So let's start off with risk tolerance as a whole. It's really about making sure when things go wrong, that you are not, those emotions are not being brought to the surface. And remember, market volatility can happen abruptly. Look at COVID, right? Markets were in a general uptrend, things were relatively fine, and then COVID hit, and then you had a big drawdown. And then it turned the other way really quick. But a lot of people who were taking too much risk were caught flat-footed. Didn't know what to do. A lot of them sold at the wrong time and locked in those substantial losses. Then you got the bounce back. And it's too late to make the right changes. So it's really about avoiding, once again, those emotional decisions. Then going back to risk capacity, that is really about your cash flow, your emergency fund, your goals that you might have. Might just not be retirement. It might be you want to leave a certain amount to your kids and grandkids. Maybe it's sending a kid to college. Maybe it's buying a second home. Whatever that is. So shedding some light on that and see what kind of wiggle room you have if your portfolio deteriorates, for example. So it informs you on how you should manage your risk exposure as well as your safety net, your emergency fund. Now, how do you measure risk? There are different ways. So you can look at things like beta, not alpha. Alpha is a portfolio measurement, but that's not about risk. That's about risk-adjusted return. Okay. So beta, average rate of return, Sharpe ratio, standard deviation, maximum drawdown, all of that. And when you can get a handle on that, then you can really hone in on if your risk tolerance level matches your portfolio risk. And that's what it's all about. And then linking that to your risk capacity. So that's an overview of kind of 3 major measures of risk and how you should think about them when making your investment decisions.